While politicians were pointing to signs of stabilization and economists were debating whether the worst was finally over, something fundamental happened in the American housing market. Prices didn't collapse. They didn't correct. They stopped moving just enough to create the illusion of balance. But affordability did not improve. Mortgage rates remained stubbornly high by historical standards, inventory remained structurally short, and millions of households discovered that the market had not become more accessible. It had simply become static, frozen at levels that assumed long-term financial endurance rather than short-term recovery.
This is the environment the United States entered in 26, and it is the environment in which sweeping housing reforms are now being promised.
Not gradual change, not technical adjustments,
but intervention on a scale not seen in decades.
The promise is relief.
The risk is distortion, and the consequences are already beginning to surface. At the center of this new agenda is an idea that until recently sat far outside the mainstream of U.S. housing policy: ultra-long mortgages. 40 years, 50 years, debt stretched across half a lifetime. The argument behind them is simple and politically powerful. If Americans can't afford homes at current prices, then lower the monthly payment.
Extend the loan. Redefine affordability.
And on paper, it works. Monthly costs fall.
Approval rates rise. Buyers re-enter the market.
But that framing obscures a critical reality. Extending debt does not reduce costs.
It defers it. With a 50-year mortgage, households spend decades paying mostly interest. Equity accumulates slowly, if at all. Ownership becomes conditional on uninterrupted income, stable employment, and a financial system that cooperates indefinitely. Supporters argue that most Americans don't stay in one home for 50 years anyway. Critics respond that debt follows households even when properties change hands. And markets respond even faster. When borrowing capacity expands across millions of buyers simultaneously, prices adjust upward. Sellers recalibrate. The affordability gain disappears, replaced by higher asset values and deeper leverage. This is not theory. It is historical pattern, and it signals something deeper. An implicit acknowledgement that prices are no longer expected to fall, that the market has crossed a psychological threshold where correction is politically unacceptable and preservation becomes the goal. This shift did not happen in isolation. It coincides with sustained pressure on interest rates as borrowing costs remain elevated despite easing inflation. Mortgage rates are forecast to remain in the low 6% range through 2026, offering only modest relief compared to previous years. The implication is clear. The housing market no longer functions comfortably under neutral rates. It requires accommodation, and that dependency introduces systemic risk. When interest rates become tools of urgency rather than calibration, markets adjust in subtle ways at first and violently later. Margins for error shrink. Housing is uniquely vulnerable to this dynamic because it sits at the intersection of finance and daily life.
When housing systems fail, they do not fail quietly, they cascade.
Even if financing becomes easier, the supply problem remains unresolved.
The United States continues to build fewer homes than it needs.
Despite rising listings in some regions, the country remains short millions of housing units, a gap large enough to keep prices elevated even in a slowing market. This is not primarily a zoning story. It is a cost story.
Construction materials remain expensive, labor shortages persist.
Financing timelines stretch. Even modest increases in material or labor costs can erase margins on affordable housing projects entirely.
Builders are not hoarding land. They are running numbers that no longer close.
This is why repeated promises to build our way out continue to underdeliver. The arithmetic does not cooperate. At the same time, capital behaves very differently at the top of the market. Luxury housing continues largely unaffected by these constraints. Global money seeks stability, yield, and insulation from volatility, not affordability. High-end developments move forward. Institutional investors absorb risk that individual households cannot. Policy choices often reinforce this divide.
Tax incentives reward capital deployment rather than occupancy.
Financing structures favor scale rather than stability. Scarcity becomes profitable. The result is a two-tier housing system. One tier optimized for asset preservation, another constrained by access. and the distance between them continues to widen. Economists now describe 2026 not as a recovery year, but as a potential inflection point, a housing reset defined more by lowered expectations than true relief. Wages in some regions are beginning to outpace home price growth. Inventory is improving at the margins. Activity is returning slowly, but the underlying structure remains fragile. Longer loan terms increase household exposure. Political pressure on rates increases uncertainty.
Supply constraints limit correction. This is not collapse.
It is normalization of risk, and normalization makes fragility invisible until it isn't. What makes this moment particularly dangerous is how calm it feels. There is no dramatic crash. No obvious crisis, just a quiet restructuring of expectations. Americans are being asked to accept longer debt, higher leverage, and permanent constraint as the cost of entry. Not through legislation alone, but through financial design. Once that design becomes standard, it is very difficult to unwind. Housing stops functioning as a ladder, it becomes a gate.
And gates reshape societies.
They affect mobility.
They alter family formation. They concentrate wealth.
They change how risk is distributed and who bears it. The choices being made in 2026 will shape the housing market for decades. This could be a careful reset, one that restores balance gradually and allows supply, prices, and expectations to realign. Or it could be the foundation of the next instability cycle, built quietly through debt expansion and defended as necessity. The difference will not depend on ambition. It will depend on restraint, because housing is no longer just a market. It is a measure of stability, a signal of confidence, and a reflection of how a society chooses to manage risk. And once those choices are locked in, reversing them becomes extraordinarily difficult.